Welcome to Fund Launch Live, my daily live stream talking about the marketing, the promotion of publicly solicitable funds such as angel list rolling funds, syndicates, and other sort of Reg A, Reg A plus, Reg A plus, Reg D, and Reg C equity crowdfunding platforms marketing for raising money. So today is a part 2 presentation. If you didn't see part 1 yesterday, and you probably didn't because no one watches this yet, we're talking about, as a GP, how do you create FOMO and interest and hype for your fund without being seen as hypey. Here's a brief recap of yesterday. Everyone wants to create hype, but no one wants to be seen as hypey. And when you're soliciting investment, the danger is especially high. For one, VC is a reputation-based business. Your reputation as a GP is hard to build and very easy to destroy. Furthermore, LPs, your audience, the people you want to solicit from, are sophisticated. If you're raising, say, a rolling fund, you can only raise from accredited investors, and you most likely will only raise, if you're investing in early stage tech companies, in investors who already have some sort of exposure to early stage tech, who are used to that level of risk. So that's a sophisticated, knowledgeable, patient audience with a strong or a fairly strong BS radar. And furthermore, the reason why it's extra dangerous to be too hypey when you're marketing a fund is that investing is serious business. It would not just be unprofessional to create too much hype, it would be unethical. A fund manager should not be promoting himself the way that a rapper or a WWE wrestler might. You have to find a happy medium where you can get your name out there without burning through your credibility. The problem is that there's a minimum level of hype necessary for a GP. Unless you already have an audience, you already have some sort of fame, you do have to get your name out there, and you can't just be an aesthetic monk who never self-promotes. So my conjecture is that there's a happy medium that does exist where you can promote yourself, get your name and your fund out there without burning through your credibility. Now, who am I to talk about the marketing of rolling funds? Let me tell you what I'm not. I'm not an investor, I'm not a financial professional, and I'm not a lawyer. This is not investment advice, financial advice, or legal advice. What I am is a social media marketer. If you want to check my resume, you can go to attractgreatguys.com. That was a brand that I was director of marketing at. We had around 400K YouTube subscribers. I managed an email list of 28,000 active email subscribers. And we did a 7-figure revenue amount, which is not amazing. That's fairly small, and I'm fairly young in my career. However, when it comes to the marketing of publicly solicitable funds, as far as I can tell, I'm the only person who's talking about this. There are people in this space that are executing, but I am not finding any sort of other publications on the study and the craft of marketing specific to this niche of publicly solicitable funds. So unfortunately, right now, I'm as good as it gets. Okay, so you are a founder. You want to launch a rolling fund, be a fund manager. You don't already have a social media presence. You're going to have to understand the art of the pitch. Marketing is sales at scale, and sales is the art of presenting a well-defined pitch to people, no matter what your offer is. If you're selling a product, a service, a religion, a national identity, a courtship, a political revolution, there's always a pitch at the end of which your prospect is confronted with a choice. They can go left, they can go right. You can't make it for them, but it is your job to drive them to the acceptance that inevitably a decision is being made. They can go left for the same results they always have gotten, or they can take a chance on something new and go right this time. Now, pitching is part art, part science. The art, the more so human element, is the content, exactly how you're, what ideas you're presenting, how your the flair, the creative content. The science is the structure. Let's say that direct response marketing began in the 1930s with the advent of mail marketing, and that since then, about 100 years now, we've had billions of dollars spent on split testing different advertising techniques, and what comes out is that we have a structure for how to present a pitch. This could be in the form of a long-form sales letter. It can be a personal presentation. I probably have 1,500 pages of marketing, sales, and pitch material in different swipe files. And I'm definitely a student of the written word, of copywriting, of writing to make a sale and a conversion. And what you'll find if you also study pitch making is that pitches tend to have a 5-act structure. Stories tend to have a 3-act structure. If you're making a pitch, it tends to be a 5-act structure. Here's the structure. If you want to make a pitch, capture attention, present opportunity, establish credibility, make offer, and go for the close. Pretty simple. 5 sections, each with their own different requirements. Starting with capturing attention, you can have the best show in the world, but if no one is in the audience watching it, it's not going to go anywhere. Capturing attention, these are your headlines. This is typically where the most wild part of a marketing effort might be, because this can be the clickbait. You don't want the reputation as being clickbaity, but you do need to get people's ears. Moving on to presenting opportunity, this is where you show the buried treasure. You create the intrigue. You discuss the upside, the mouth-watering upside, and the opportunity, and the buried treasure that can be discovered if your prospect listens to you a bit longer. From there, we get into establishing credibility, because anyone can tell tall tales. Anyone can make wild claims. The difference between a good pitch and a bad pitch is whether the prospect believes your claims. And as an investor or as a prospective fund manager, credibility is paramount. Investors are a fairly sophisticated audience, and they're going to judge you heavily on your reputation and your qualifications. And this isn't like selling supplements where you can just make some sort of crazy set of claims. You need to have the track record to back it up. Then 4, we move into making the offer. Now, the offer is when you pull the curtain back and show the deal from all angles, and that includes the downside. When you're presenting opportunity, you're generally just speaking about the upside, the mouth-watering intrigue. You're showing the buried treasure. When we get into making the offer, that's where you reveal the dragon at the mouth of the cave that you have to slay to get to the treasure. It is unethical to make a pitch and not disclose the full risks, uncertainties, challenges, and effort that will be required to attain the upside. However, you are allowed to wait to discuss the downside until you've discussed the upside. First, if you start any sort of pitch by just talking about the bad things about your product, no one's going to stick around to listen to the good parts. And finally, we're back to the close. When you're in phase 3 and 4, establishing credibility and making an offer, you're getting a little more into the technical, the specific, the logical, whereas phases 1, 2, and 5, capturing attention, presenting opportunity, and making the close, are emotional. Sales is ultimately an emotional process. You start by capturing emotions, creating intrigue, mouth-watering, and you also want to close on that same emotional note, because ultimately it's going to be the emotions that make the conversion. But on the close, also specifically, you have to confront the prospect with a choice. You can't make a choice for them. You can't make them choose left or make them choose right, but you can bring them to the awareness that they are at a crossroads, and that even not making a choice is still making a choice, because they're choosing to go left as they always have, whereas they could take a chance to get different results by going right. You can't make them choose, but you can force them into the decision. So that's pitching in a very high level, or a very bird's eye view, not terribly specific. It's a general framework, and I want to talk about how how you as a fund manager can apply that in the promotion of your fund, perhaps. So let's talk about risk here. Obviously, as a GP, your reputation is paramount. You cannot afford to destroy your reputation. It's definitely possible to pitch your way into bankruptcy because your reputation, or perhaps not bankruptcy, that's a bit dramatic, but pitch your way out of the business. Reputation is a lot like gasoline. It's flammable. And when it's on fire, everyone's going to come out and watch and offer an opinion. We've all seen sales pitches, marketing ads that are short-sighted and foolish and scammy, where the pitch is aggressive, it's pushy, it's boilerplate, it overpromises, and you're sure they're going to underdeliver. And that is, one, it's bad ethics, but it's also bad business too, because when you make a unacceptably large or wild pitch, you are gaining some fast money, but at the expense of long money. You're optimizing for the first sale, but ensuring that the first sale you make with this prospect is the only one. You stunt the revenue of your own business, or in this case, a fund. And furthermore, you actually destroy the business because it ceases to be a business without brand equity. If you only gain sales every time you make ad spend or you go out and meet with people, you have a job, not a business. There's no sort of passivity, no sort of, quote, passive income or passive customer acquisition coming to you. So burning through your reputation and making wild pitches just ends up shooting yourself in the foot. And I bring this up right now just because I want to reassure any prospective GP in the audience that absolutely there is risks of being too marketing forward. As a GP, you have to be vigilant not to overhype because, one, investing is high risk. You want to maintain a professional demeanor and not make wild claims because there's a lot at stake. Two, obviously there are a lot of swindlers in the finance industry. Anyone who's scrolled through TikTok and watched stock trading TikTok can see how many BS artists there all are. And three, you're in a regulated industry. There are legal consequences to being too hypey. However, that does not mean that you, spoilers, damn it. That does not mean that you don't pitch at all. If you don't promote yourself, you'll be doomed to obscurity. I used a poster here of The Man Who Wasn't There, an underappreciated Coen Brothers movie. It's a nice gem. I like it. If some investors don't have to pitch very much. When Sahil launched his rolling fund, he launched it with a tweet, but that's because he already had the reputation and the audience that allowed him to do that. If you don't have that reputation, you're going to have to self-promote if people don't already know who you are. So perhaps you should think of self-promotion and creating hype a bit like raising money for a startup. You can absolutely raise too much money, but you can also raise too little and never get off the ground. And you have to find a middle way between the two where you get just enough hype to act as rocket fuel to get you off the ground. The hallmark of bad hype, the hallmark of burning your reputation is impatience. The reason why a used car salesman feels sleazy is that they're not counting on your reputation lasting after you leave the lot. To use a rather crude analogy, the danger of a one-night stand isn't that you're spending the night with a stranger. It's that they might not be there for you in the morning. Now, my sort of hypothesis with this account and with these live streams is that there's a way to blend the tried and true principles of direct social media marketing and use those to grow your fund without burning your reputation. If you do one thing, and that is extend your time horizon. And that should be pretty easy for GPs, right? You already operate in an industry where you're looking at taking an investment in year 1 and it might not pay off until year 10. You have a naturally long time frame. Well, the launch of your fund should also follow a fairly long time frame if you are building your reputation from zero, or should I say building your social media reputation from zero. You should already have a reputation amongst past associates, but if you want to solicit money from the public on a publicly solicitable fund, like a rolling fund, then you're going to have to bring that reputation onto social media, which is a different affair. And I think that you can effectively market yourself without burning credibility by using the same principles that we discussed on a sales letter, capturing attention, presenting opportunity, establish credibility, make the offer, and make the close, but extending the time horizon from 1 hour to several years. Typically, a pitch might last 20, 40, 60 minutes from start to finish. I'm saying to sort of disintermediate the pitch and live the pitch over the course of 2 years. Sounds odd. Let me show you an example of someone who is doing exactly what I'm talking about. Can you guess who this person is? Cody Sanchez. I've talked about her a lot because I think she's such a great example of walking the middle ground, where she is a self-promoter. She does have a team that helps her market herself and her content, but she does it in a very above-board, long-term, credible way that doesn't burn her long-term reputation. Now, Cody has a fund on the AngelList platform. Let me show it to you. It is Contrarian Thinking Capital. Contrarian Thinking is her brand. Not a bad brand name, huh? $50K minimum commit, 2 and 20 fees. She has a fairly long fund launch memo here. You can tell she put a lot into it. So, Cody has a fund. I want to take the 5-step framework of pitching that I discussed: capture attention, present opportunity, establish credibility, make the offer, and make the close, and sort of overlay it over how she built her brand and launched her fund. So let's talk about what Cody did right, which is 6 things. Starting at the 0th index, she extended her timeline. Cody's had a personal media brand for going on 3 years now. And about 2 years, well, maybe more than 2, maybe 2 3/4, let's say 2 years before ever launching her fund. She invested in building her audience before she knew how she was going to monetize them. And because she did that, maybe the strategy wasn't perfect. Maybe she wishes that she could have gone back knowing in advance how she wanted to funnel her audience into monetization. But that's overwhelmed by the fact that it gave her more time with her audience. And the longer your relationship is, the stronger it is. So let's go into the number 1 thing she did right is captured attention. If you look at Cody's content, particularly early in her career, she's making interesting content, more so than self-promoting or biographical content. She's finding the most interesting stories that are relevant to her kind of business niche and putting those at the forefront, rather than necessarily the stories that just belong to her and her career. Chances are the most interesting stories that are relevant to the audience you want is not necessarily from your life, because there are 7 billion other people on Earth with stories, and they probably have some that are more interesting than yours. So when she began, she wasn't optimizing for her biography and putting her story out there. She was optimizing for putting interesting stories out there, regardless of the source at which it came from. Now, let's say, hypothetically, let's divide up the launch of a social media brand over, that took her 2 years to launch the fund. So let's say, just for the sake of putting numbers out there, that the first 5 months of her social media brand was just being a source of interesting stories relevant to her niche. Moving on, so it's like a sales letter, but over the course of 2 years, moving in, presenting opportunity. Cody took ownership of an idea. She is the boring business investor. While a lot of other brands are talking about tech or crypto or Web3 or more saturated markets like that, she went the opposite way. She went the contrarian way and branded herself as the boring business investor, taking people into the idea, the opportunity of one, making $1 million by doing boring, regular stuff that doesn't seem as sexy to talk about at parties, and two, by making the observation that perhaps it's better to invest your way into a fortune than to build. It's better to buy someone else's established business rather than it is to necessarily build your own business. Now, let's say hypothetically that if she spent 4 months out of 2 years capturing attention with just interesting general content, let's say maybe she spent the next 6 months owning this niche of presenting the opportunity of being a boring business investor and becoming the sort of authority on boring businesses. Following into establishing credibility, remember, we're applying the framework for a pitch over, say, a 2-year period of time about someone's social brand. Cody began making more biographical content about her own success within the niche that she's established. Now, Cody's had a pretty successful career overall. She has an MBA from a prestigious school. She's done fairly prestigious work at Goldman Sachs and been on Wall Street working in private equity. And but what's more important to her raising money on a rolling fund was the fact that she'd already made acquisitions and ran businesses in her specific niche of opportunity. By the time that she began making biographical content, she already had a portfolio of something like 26 different boring businesses that she ran as a portfolio, and she bought from boomers and modernized, which gives her not just general business credibility, but specifically the credibility of operating and executing in this niche. Now, a year in to her brand, or maybe 2 years into her brand, she begins discussing the possibility of making an offer. Let's take a look at this. The first instance I can find of Cody discussing a rolling fund, this is January 2021. What if we create a fund I said rolling fund, it's not a rolling fund. What if we create a fund syndicate to invest in cash-flowing, boring businesses? Remember, she had already branded herself as the cash-flowing, boring business person. And also, she had extensive career experience in private equity. So on May 8th, she makes her first kind of hint towards launching a fund. How long does she wait to launch the fund? About a year. It's not until April of 2022 that she announces Contrarian Thinking Capital, a boring business infrastructure fund. So she waits about a year between first making a teaser and finally launching the fund. That's about 2+ years into her social media brand career that she waits to make the offer. At this point, her audience has had 2 years to get to know her, know that she's trustworthy, really absorb the extent of her experience and credibility, and latch on to her ideas. Upon making her offer and launching her fund, all she has to do is close, and she does that in a very clever way. She announced her fund first through her paid email list. Cody's social media brand, Contrarian Thinking, has 2 tiers of email list subscribers. She has her free tier and she has her premium paid tier. Those subscribers pay $1,500 a year to get her premium content. Obviously, her paid subscribers are higher quality subscribers. They're more interested and invested in her ideas. And because you're paying $1,500 a year for an email list, there's a greater chance that there are accredited investors in that audience, because it sort of filters out filters for money by requiring a paywall. So Cody launched her fund first to her email list, her paid email list, letting them know that, well, guys, I'm looking for $5 million to seed my fund. there's a limited number of LPs that I can accept on the AngelList platform with this fund structure, and I want to give you guys the first opportunity. She made a fund launch memo, an email, and a landing page that I broke down on previous live streams. And the important thing here is that by offering her first dibs for the fund to her paid email list, she, one, was able to sort of segment for her hottest or most interested prospects, but two, she was able to create a natural source of urgency. She was able to say, there's X number of subscribers on this paid list. I'm only looking for Y amount of money. I'm going to give you this, guys, the opportunity to get your money in first for, first say 24 hours. But after that, I'm going to my following of hundreds of thousands of followers, and you're going to be one of many competing for the spot. And that's a really good way of a natural organic source of FOMO is through that sort of list segmentation. We mentioned that at the close is when you're presenting the prospect with a decision. And through segmenting her offer for her paid list exclusively, she presented them with the decision that, am I going to get in now while I have this exclusive opportunity, or am I going to wait and hem and haw and possibly miss it when it opens up to retail, if it even does open up to the rest of her following base, which it never really did. She raised money so fast. Let's see. So after sending one email to her paid list, within 2 days, she had raised $2.2 million in commits from 41 LPs. Within the course of a week, she was at $5 million, which was her cap on her fund. I don't believe that she ever got this offer out to anyone except her paid email subscribers. So anyways, that's an idea, a hypothesis of how you as a fund manager might, it's an idea, take the framework of pitching and remove the stink of hype by applying the same principles of sales, but extending your timeline and investing years into building the relationship, starting early rather than starting late and having to cram these 5 steps into 1 hour, a 1 hour pitch, or the process of just a few weeks. Anyways, I hope you enjoyed. Probably no one is watching, but I do this live stream every day. I'm trying to make them more prepared and less rambly stream of consciousness. That's why this and yesterday's were done off a slide deck. I think I'm going to continue that trend. Thank you for watching.